Hello, this is Marie Gibson with Gibson and Associates, and I'm here to share with you how we're going to actually pay off those loans that your owner keeps buying and then paying off, and he's earning a ton of money, and he's able to make those loan payments and zero them out and move on. He's doing really well. So I have on my screen right now, it's a check. It's the check that we're going to pay off that loan. Let's say the balance was $35,000, pay off that loan. And you can see here, it's to pay off the loan balance on equipment number 1. I have the check number, or this could be an ACH, right? Sometimes our owner does all kinds of interesting things with their checking account, and they're paying with points off a credit card. Anyway, we're considering that this is from our checking account. It's to pay off the loan. They gave us the loan balance, and it's actually paying off the equipment loan for number 1. And so that's a long-term liability. We had expected it to be a loan for 3, 4, 5, 6 years, but lo and behold, business is booming and we're ready to go. So we actually just pay off the check and we're going to save and close. And thank you very much. And there is our check in our checking register. The catch is that when we actually go into the loan, and this, I found that loan through my chart of accounts. Here's my chart of accounts. I scroll down. Here's my equipment loan. And look, it has a balance in there. Well, no, we just paid it off. And so the question, and you can see here was the starting balance. And I just made these up real quick to give us the example, but we had these monthly payments, 900, 900, 900, right? Here's all our monthly payments. Those monthly payments might have gone on for a year. They might have gone on for 2 years. Regardless, what happens is here's the payoff amount. And gosh, we still have a balance on the loan. Well, loans, payments for equipment loans are divided into 2 parts. One is the principal portion, and one is the interest portion. So what has happened in these payments, all the previous payments, is there was no split recorded. There was no principal and interest. It was all just said, okay, this is the principal portion. Or sometimes I've seen people post it all as the interest portion, right? When you pay off a loan, we want this balance to be 0. Now, usually it's not this large. So I'm going to say that I had a little typo here, and that in the big scheme of things, that payoff amount was really $39,000. I had typed it in incorrectly when he gave me that information. Okay, and if it's my story and I'm sticking to it. So now you can see that the balance looks a little bit more reasonable. $600 is what's left, but there isn't. It's paid, it's done, it's zeroed out, move on. And so what we want to do is we actually want to decrease this loan by that $600 on the same date that the loan was paid off. But what are we going to call that? What are we going to post it against? Well, we're actually going to post it directly to interest expense. And so our interest expense sometimes is called loan expense. Sometimes you just have it categorized as interest expense. And then we might memo something that says it's entry. It's a journal entry, basically. In this case, it will come through your software as a journal entry, right? But it's an entry to 0 loan balance to 0 equipment, which sounds kind of redundant, right? Equipment is paid in full as of this date. And you might even say payments, loan payments, previous loan payments, right? Because we like to be explicit. Sometimes I write a story in my memos. Previous loan payments never split between principal and interest. There you go. And then we'll save and record that again. And in the big scheme of things, that zeros our balance. So glad I could help. Talk to you soon.